Why is the market making new highs every day if we have these problems? The greatest one, of course, is the pandemic. The Fed and Treasury actions, and specifically the reduction of the Fed funds rate to zero, has had a very coercive effect on the market.
Howard Marks has generated a 19% compounded return in the stock market over many years, and this week he sat down with Bloomberg to discuss his opinion on the outperformance of growth stocks like Tesla and Amazon when compared to traditional value stocks that have historically beaten the market. In all likelihood, you would classify yourself as either a growth, value, or dividend investor, but today, with the help of some clips from this interview, I'm going to show you why none of those rigid strategies are the key to producing strong and consistent returns in the stock market. I'm also going to demonstrate what Marks says in this interview with some examples from my free spreadsheet resource, which you can download for free down in the description below. So if you want, get yourself a free copy of the spreadsheet and test some of the stocks in your own portfolio with me a little bit later in the video. So with that said, if you do enjoy today's video and get some value out of it, I would very much appreciate it if you could take the 2 seconds to leave a like on the video. And hey, if you get a ton of value out of today's video, then consider hitting that subscribe button and staying up to date when I post new content. But with that said, let's jump into the first clip.
Over the past 10 years, if you invested in the Russell 1000 growth instead of the Russell 1000 value, if you invested $100,000 in the Russell 100 growth, you'd have almost $500,000 today on a total return basis. And if you invested in the Russell 1000 value, you'd have less than $300,000.
What was the starting point, Eric?
Enormous. Pardon me?
What was the starting point?
100,000. So
no,
you'd have
when?
5 times.
When?
Oh, 10 years ago. So you'd have 5 times your money over 10 years in growth stocks, and you'd have something less than 3 times your money in value stocks. And that forms part of the evidence that another legendary value investor, Jeremy Grantham, points to say that we're heading for one of the mother of all crashes.
In this first clip, the Bloomberg host shares some results of investing in the Russell 1000 value versus the Russell 1000 growth over the past 10 years. And these indices are made up of hundreds of the biggest US companies and are categorized based on traditional value and traditional growth characteristics. The Russell 1000 value index is made up of approximately 850 stocks that exhibit traditional value characteristics. Primarily, this includes stocks that have a low price to book ratio, so the price of the business or the stock compared to the book value or equity in the company on the balance sheet, as well as a low price to earnings ratio, comparing the price of the stock compared to the earnings per share or the profits per share. And when I say a low price to book or a low price to earnings, I mean stocks that have a relatively low value for these ratios compared to other businesses in the Russell 1000 index. The Russell 1000 growth, on the other hand, is made up of approximately 450 stocks that exhibit traditional growth characteristics. Primarily, this is high expected growth in earnings or profits in the next couple of years, as well as high expected growth in sales or revenues. The Bloomberg host talks about the last 10 years comparing these two indices and their returns, but even if we look over a 15-year period, including the GFC, then even over that period, value has lost massively in terms of overall returns to the growth part of the Russell 1000 index. The Russell 1000 value index has delivered 7.8% annually over the past 15 years, and that's compared to the Russell 1000 growth, which has delivered 12.5% annually over the past 15 years. The host's argument here is that this demonstrates that growth businesses as a basket, as a group, are in a bubble or are massively overvalued because they have considerably outperformed value over the past 10 or 15 years. And this is completely flawed logic. And in this next clip, Marks explains why.
I went back, Howard, and reread the section on bubbles and crashes in your book, Mastering the Market Cycle. And I should remind everybody who hasn't read it, it's a warning, right? It serves as a warning to investors not to be seduced by the idea that price doesn't matter. And here's my question. What if we are in a bubble and prices of even the greatest growth companies, we can talk about them, Amazon, Tesla, Microsoft, are excessive? What if?
Well, that's a great question, Eric. But the Andrew's point, which makes a lot of sense to me, is that you have to really know a company well before you know it's overvalued. If you say, well, let's screen on the market for attractive investments, and we'll say that any PE over 25 is discarded? Well, there are companies that are worth PEs over 25.
Many people will look at something like the Shiller PE, which compares the price of 500 big US companies to their earnings over the past 10 years, and say, look, the prices of these stocks compared to earnings are so much higher than historically, and use that as evidence that the stock market is overvalued. However, all that ratio shows you is the price of businesses compared to the earnings in the past. In this case, for the Shiller PE, it's earnings for the past 10 years, when what really matters to investors is the price compared to the earnings that come in the future. A business cannot use the earnings they produced 10 years ago to pay a dividend, in most cases because they will have already paid it out as a dividend or used it to reinvest in the business. For the most part, a business will be delivering cash to shareholders, delivering return to shareholders from profits that they produce in the future. And Mark's key argument here is that the only way that you can accurately and reasonably project or estimate what the future profits of a business are going to be is by deeply understanding it. And even the greatest investors in the world, like Charlie Munger and Warren Buffett, admit that they only deeply understand and know how to value businesses in a select few industries. And for the vast majority of stocks, they actually don't know how to project or estimate what the future cash flows will be. So unless you think you are smarter than every investor who has ever existed, then you and I have no idea whether the market overall is undervalued, overvalued, fairly valued, or in an irrational bubble. Another really important point that Marx makes here is that even though most or some of the stocks on the stock market that have a price to earnings ratio above 25 may very well be overvalued, it is entirely possible for a business to have a high PE ratio and actually be undervalued, not just fairly valued, but even undervalued and a good investment. So in this next part, before we get to the next clip, I want to use my spreadsheet to show you how a low PE stock, a stock with a low price to earnings ratio, can be overvalued in some circumstances, and how a high PE stock, a stock with a high price compared to their past earnings, can actually be undervalued. Now, I've deleted some parts of the full spreadsheet just for simplicity's sake in this video, but if you're interested in going deep on how to value stocks, then I recommend joining the waitlist for Learn by Example, which actually will be opening for enrollment in about a week, and the students in there get access to a full valuation crash course which goes deep on this topic. I'll talk a little bit more about this towards the end of the video. In this example, we have two stocks that we're going to compare, one with a low price to earnings ratio and one with a high price to earnings ratio. Both of these stocks have earnings of $10 per share. You can see in the year 2020 column, the value stock currently has a share price of $50 per share, meaning it has a price to earnings ratio of 5, very low. And the growth stock currently costs $300 per share, meaning it has a PE ratio of 25. If the value stock is expected to grow earnings at 0% per year, meaning they just have the same level of earnings every single year forever, and the growth stock is expected to grow earnings at 15% per year, then the value stock is a better investment. The return that I'm targeting in this spreadsheet is a 15% return, and that is dictating the buy price, meaning if the current stock price was equal to that buy price, then it would deliver us about 15% returns per year. And using these assumptions, you can see that the value stock has a buy price that's higher than the current stock price, meaning it would be a buy and should likely deliver 15% or more returns. And on the other case, we have the growth stock that's price is actually higher than the buy price, meaning it would not deliver 15% per year returns. Now, on the other hand, if the value stock is expected to grow earnings at negative 10% per year, meaning earnings are expected to decline, and the growth stock is expected to grow earnings at 25% per year over the next 10 years, then the growth stock is actually a better investment, even though it has a higher price to earnings ratio. In this case, you can see that the value stock has a price that is higher than the buy price, meaning it will deliver below 15% returns, and the opposite is true for the growth stock, whereby its stock price is below the buy price, meaning it should deliver above 15% returns per year. In this next clip, Marx goes on to explain what a much better strategy for selecting stocks is, rather than just focusing on either traditional value or traditional growth stocks.
There needn't be a firm schism or dividing line between value investing and growth investing. As you know, my son and his family have lived with us for a lot of the last year due to the pandemic, and he's a very thoughtful investor. We've had a lot of discussions on lots of subjects, including this one, and he laid out criteria for value investing based on the understanding of securities as stakes in actual businesses, focus on their true worth as opposed to their price, the use of fundamentals to calculate intrinsic value, the recognition that attractive investments come when price diverges from value, and the emotional discipline to act when such an opportunity is presented and not otherwise. And it seems to me that, number one, there's no reason that you can't do so-called investing in growth companies on that basis. And number two, there's nothing in there about low PE ratios or anything like that. So it should be, the point is the investor's mentality should be eclectic. And you shouldn't decline to invest in companies just because they're fast growing and carry high PE ratios.
And as you can see, Marks has essentially laid out many of Warren Buffett's core value investing strategy, in that the price to earnings ratio really is irrelevant to us. What is relevant is the price compared to the future profits that the business can deliver to us. Now, it's important that you don't just run off now and think that you can buy any growth stock and that every price is justified. That is certainly not what I'm saying or what Howard Marks is saying in this video. Price still matters, and for many growth businesses, I would probably argue for the vast majority of growth businesses, even though I don't understand them, the expectations for growth in the future are so high, meaning that they need to perform perfectly. They need to become the biggest company in their chosen field, in their chosen industry, with absolutely no problems, just to deliver you an average market return. The key here is to come up with a reasonable expectation of what the profits will grow at in the future. Something that is a high probability of happening, not something that is a 5% probability of happening or a 1% probability of happening. You need to find something that you are confident the business can certainly deliver. And in those cases, if a business lines up in a way in which you can buy it, where the market's expectations for growth are below what is reasonable, then you can invest in those businesses and make a substantial return. And these kinds of opportunities are extremely rare. I look at the market and a lot of stocks all the time and have been doing so over the past few years, over the past half decade, and I have only found a handful or less of these really good opportunities. And when I found them, they have been absolutely fantastic. But the vast majority of the time, high growth stocks are priced really high for huge expectations. And even really low PE stocks are often priced too high for what is reasonable to expect out of those businesses in the future. Now, as I mentioned earlier, my private investor platform and community, Learn by Example, will actually be opening and taking new students for the first time in 3 months. So we'll be opening up probably next week sometime. And in there, you get access to a full crash course on valuation, where I go deep in how to use my spreadsheet and analyze businesses that you understand and come up with an accurate projection of what they can produce in the future, and therefore be very confident at what price you should be investing in those businesses. You also get access to a bunch of other resources. So if you want to get access to all of that and be notified when I am opening up the platform, then make sure you click the link down below and join the waitlist. And you will want to be on that waitlist, because last time, as soon as I sent out that email, within the first 2 days, half of the spots filled. So they fill relatively quickly because I don't open the platform all the time. So if you are interested in that, I'll be sending out a full information email with everything you need to know about it and how much it is and all of that in about a week's time. So make sure you're on that waitlist if you are interested. But I hope you guys got some value out of today's video. And if you did, I would very much appreciate it if you could take the 2 seconds to leave a like on the video and hit subscribe if you want to stay up to date with content. I'm posting about 2 videos a week at the moment, and I'm always happy to take feedback on what topics you guys want to hear about. You can leave them down in the comment section below, and I'm always reading through those comments and answering comments as these videos go live. But with that said, hope you guys enjoyed today's video, and I'll see you guys in the next one.